You got options. Execute your trade. You bet your money just got laid. Convex.
Welcome to You Got Options, an exciting series right here on Top Traders Unplugged, hosted by none other than Cem Karsan, one of the sharpest minds when it comes to understanding what's really driving market moves beneath the surface. In this series, Cem brings his deep expertise and unique perspective, honed from years of experience on the trading floor to candid conversations with some of the brightest minds in the industry. Together, they unpack the shifting tides and underlying forces that move markets and the opportunities they create. A quick reminder before we dive in. You Got Options is for informational and educational purposes only. None of the discussions you're about to hear should be considered investment advice. As always, please do your own research and consult with a professional advisor before making any investment decisions. Now, what makes this series truly special is that it's recorded right from the heart of the action on the trading floor of the Cboe. That means you might catch a little background buzz, phones ringing, traders shouting, as Cem and his guests unpack real-world insights in real time. We wouldn't have it any other way, because this is as authentic as it gets. And with that, it's time to hear from those who live and breathe this complex corner of the markets. Here is your host, Cem Karsan.
Welcome back to another episode of You Got Options from the Cboe floor, brought to you by Top Traders Unplugged and Kai Media. Today we get to talk to no other than Benn Eifert, the professor. He dives deep today on options, vol, and the coming regime, where we are in correlation, what happened recently with the tariffs, and what does that mean going forward? What are interest rates doing? How is that going to change the market structure for volatility for different products? Tune in. I think you're really going to like this one.
Yo, live it up, don't settle for less. You got options. Put your skills to the test. It's your call. Time to strike. Make your move. Grab the mic. You got options. Execute your trade. You bet your money just got laid. Convex. Time to straight the fade. It's the nexus of the game.
So today, after a couple macro conversations on You Got Options today, we get the professor. We're going to dive deep with Benn Eifert, CIO and managing partner at QVR. Hey, Ben, how you doing?
Dude, it's great to see you, man. Thanks for having me out here. I'm really excited.
Thanks for coming all the way. I know you took the red eye in from San Fran today, so we really appreciate it. And you got it's like summertime in Chicago, and we get the
pouring rain.
You get 24
Exactly.
hours of rain, unfortunately, but yeah.
It's all good.
But welcome to the Shy. This is fun. This is one I've been kind of looking forward to having for a while. I think, as I was saying before, there aren't many people who kind of see the big picture in vol and can dive as deep as you can. So I want to start out today about talking about kind of one of the most important things with options and implied volatility is their relationship to equity markets and kind of the beta that they have, the correlation they have, when it works, when it doesn't. Maybe give me a little thoughts on what happened at Liberation Day, how vol performed there and maybe why, and how you see that performing going forward as well.
Totally. So this is a really, really important topic, right? I mean, so a couple of key things. When you think about how is vol going to perform in a market event as markets are falling, a couple key things. One, there's like the speed of the event, right? And a lot of people don't think about this. They just think about, the S&P is down 10%. How much is vol going to go up? But it's like, if that's 10% is in one day, or in 1 hour or in 10 minutes, that's going to make vol spike like crazy, right? Because the value of convexity of like rehedging your delta and your gamma on a move like that is really high. If that 10% is a slow bleed down over a month or two, vol might barely even rise, right? It might start to rise at first and then kind of fade because underlying like the value of volatility again is in that realized volatility, how much money that a dynamic hedger can capture as they're rehedging. And so, you get like a 22 style sell-off, right, where the market was down very significantly over the course of that year. But vol kind of tried to rally, in the early parts of the year and then just faded and didn't perform, right? Because you've got that like slow, choppy grind down. So that's really, really important. And then related to that is, positioning, right? And that positioning drives a lot of like the speed of moves down. But, if the market is pretty well hedged, if, the buy side isn't overextended, long levered, if market makers aren't too short gamma, like it's really hard to get that really heavy, significant vol performance to the upside. You really get that huge vol performance when everybody's over levered, everybody's bullish, everybody's crazy, people are selling vol like nuts, and then they're scrambling to cover, they're getting blown out. Like that's when you get that vol event.
Supply and demand, right?
Supply and demand.
It's funny how you can get into all the, quantitative kind of details and Greeks. But at the end of the day, supply and demand
100%.
is the most important thing, and particularly in a convex instrument like an option, I think.
That's exactly right.
I think, I focus a lot on dealer positioning. I know you do as well. I think it's interesting if you walk through the history of these kind of the correlation of vol relative to declines. It's almost like a sine curve. And what do I mean? If we go back to August 15, yuan devaluation, you probably remember this, right? Massive vol event, right?
Absolutely.
Screens kind of went black. It wasn't that big a move. It was the biggest move that we had since 2009. But I think it was an 8-9% decline, right?
Yeah, that's
but
right.
it happened quick. It was a matter of a couple days, and that vol exploded, right? So what happened 6 months later? Everybody's always fighting the last war.
Bingo.
All the short vol entities got washed out to sea. The long vol traders all got sort of taken on flows, and they had made a bunch of money, so they had more to invest. February 16, right? Oil goes to 20, high yield starts blowing out, and everybody's like, here it is. It's coming back.
And
they load up on puts.
Right?
It doesn't work at all.
Yep.
And I think the important part there is not just that the implied vol doesn't work, but reflexively, it drives less realized vol. That decline was much slower, stair steps, but also very interestingly, it was a bigger decline. So instead of the 8-9%, we got 12% because hedges were not working.
Yeah, I think that's exactly right.
Right. And then we can go right back, like 16, and what happens? We go through 17, vol selling. Everybody's like, why would I own puts? Because in Feb 16, the biggest decline since 2009, it doesn't work.
Totally.
So vol selling comes in, XIV gets shorted.
Yep.
Volpocalypse.
Kaboom, right?
Kaboom.
No, it's very cyclical because exactly to your point, it's driven by positioning.
Right.
And positioning is very heavily driven by what just happened last time, and everybody's got a short memory, right? So it's like, you have a huge blowout of short vol positioning, and you have big inflows into tail hedges, big inflows into long vol ETFs from retail.
Right.
And then you get the unsurprising underperformance of like long vol positions. They bleed to death. Short vol's performing really well. Everybody's piling in. A couple years later, like now we're massively crowded short again, and we repeat.
Totally. And actually, if you just continue that, just to finish the thought here, because I want to illustrate how sinusoidal it is. October, November, December 2018, 19% decline,
Exactly.
right? Like the biggest by far again since 2009.
Yeah, and December
And
every day,
October,
1 or 2% down,
November.
1 or 2% down, no realized
That
vol.
was awful. That was like so painful.
Yeah, exactly.
COVID, massive vol explosion again, 22 then.
Slow grind down.
And so the question now this leads to, right, is we just had 22 and then we had a vol event in Liberation Day, a pretty big one, right? Are we going to get the vol compression decline? And again, that doesn't mean it's less of a decline. It doesn't mean decline's not coming, but it could be an even bigger decline in theory, right? With less, like a little bit slower. And so the question is that what you think is the case? And if not, why? Talk to me a little bit about what you see coming if we get a decline. And let's just say the next decline, if it happens to happen the next year or so.
Yeah, absolutely. I mean, when I look at positioning today and market dynamics today, you've got institutional investors pretty bearish, pretty underweight, chasing a little bit of upside, but again, like very low net leverage. That started really with like the deep seek sell off and the factor rotation blowout that happened in February, and then again with Liberation Day, reevaluation of the macro landscape. What are the macro risks out there? Policy instability, tariffs, all this kind of stuff, right? So you have institutions really, really underweight. You really don't have much of like the crazy short tail risk selling, crazy vol selling. There's a ton of vol selling through things like call overwriting, cash secured put selling, but those are actually like market stabilizing forces, right? Those don't create tail risk. Those are unlevered strategies. They supply gamma to the street. They supply gamma to guys like us, and we dynamically rehedge that. We suppress volatility. You don't have, the net 2019, 2020 dynamics with people selling variance swaps and people selling crazy stuff that's going to, blow up in a nuclear bomb.
Right.
So without over-levered fast money positioning, without super over-bullish, institutions, without tail risk sellers, it's really hard to see that really big vol event, that huge outperformance of vol and that fast crash. I think, if you see a sell-off over the next 6 months or over the next year, I think it's going to come from, kind of fundamental headwinds and challenges in unstable policy environments, going to come from declining earnings. And then that, you're going to see retail trying to buy the dip. You're going to see kind of more of like a slow, choppy sell-off where explicit, simple long vol positioning just might not work.
Right. I completely agree. And I'd be remiss if I didn't talk about the taco trade and the reality of the vol compression that's coming from the administration. talk to me a little bit about how you see that playing in here, and if that's having an effect. I'd love to hear your thoughts.
Yeah, I mean, I think the way that I think about the administration's stance here with respect to volatility is, in some sense, there's like an administration put in the market where, even if Trump says he doesn't care what happens to markets, I'm not sure that's right. I think that he doesn't like it if, when there's bad headlines about equity markets are down, and if there's some set of policies that the market's pushing back on, eventually he's responsive to that. So that compresses the downside to some extent.
It's also polling, right? Because the market goes down, and that's bad for polling his first 100 days.
Very much so.
So there's almost a force kind of reaction function.
Very, very much so. And then I think, on the upside, when vol starts to fall, when markets start to rally back to highs, this is an administration that I think that's very dedicated to like being disruptive and doing new stuff that people don't necessarily expect, and that's counter to the economic consensus or whatever. And so I think as they get emboldened that, vol is low, then it's more likely to see new policies kind of thrown at the market that can create some volatility and create some uncertainty. So I think that's it's this very like rangy kind of dynamic, right? Where I think volatility is supported, from below by the fact that, you've got administration that wants to do tariffs and wants to do a bunch of new stuff. But at the same time, they don't want to see a crash, and you don't have the positioning in place to get a crash.
Yeah. We need a new acronym for like the upside part of that trade.
Yeah, exactly.
There's a listener who has a better kind of another food item acronym.
For sure.
Great. No, but I do think you're right. I think the second markets start grinding up, Trump and the administration feels emboldened to institute some of their big policies, which are disruptive, obviously. And so you can kind of get this quick market rallies. We're going to push out some policy that's scary, and then a saving of the market below, which can create that range bound trading. The other thing I wanted to highlight, which I thought is very important that you brought up, that I don't think gets talked about enough, is structured product issuance. The amount of, not just structured products, but also ETFs now. We have seen an increase in the last 3 years from $500 billion of structured product issuance to almost $1.5 trillion. It has almost tripled. I mean, that's hard to like comprehend, but the majority of those structured products are vol compressing, right? And not to mention all the ETFs and everything. So there's a structural offer in equity vol, in particular at the index level.
Very much so. And it's part of, this broader trend of retail investors, high net worth investors getting involved in options and derivatives and futures and crypto and, risky trading. Yeah. The structured product boom has been wild. So, I've been involved in structured product markets for, decades. They used to be a Europe and Asia thing, right? You used to be US folks traded stocks. But what you saw after 2020 was a huge migration to where the big growth in structured product markets was in the US. And not just in the US, but actually unusually kind of evenly split with index, which has always been a big thing, but also single names.
Right.
So when you look at a lot of the structured product baskets that trade now are all of retail's favorite names. It's NVIDIA and Palantir and Tesla, all the momentum names, right? And so what that does, most of those products, there's a million different kinds, but the core thesis is usually it's selling long-term crash risk to get yield, right? So what you see is the long-term vol and option prices in the downside wing, and all those names and an index gets crushed, goes below the call side. And so, we can I'm sure we'll talk about this later, but when you're thinking about where is there cheap convexity in the world, being on the other side of that kind of long-term crash risk is a really nice way to get.
We might as well talk about it now. You dove in, like, I think that, like, dispersion, right? I think, we are seeing so much index vol compression, and some of it's the macro, right? The reality is we are seeing more different news in big ways that is changing outcomes for single names. But we are also seeing a dramatic amount of vol compression at the index level that then is pushing correlation away from each other. Maybe speak to that a little bit. Again, a big idea that not a lot of people get, but I think a very important one.
Yeah, very much so. So, dispersion is a very standard trade that a lot of people have been involved in vol markets for a long time. So a dispersion trade typically is where you're buying a bunch of single name vol on the index weights, kind of buying the index weighted basket of single name vol, and then you're selling index vol against it. So historically, index vol used to be pretty expensive. And so that people thought of dispersion as like a risk premium where you were just always supposed to do that trade. But exactly as you allude to now there's a lot of index vol compression, right? It depends on what tenors you're looking at, but especially in the short end, there's a ton of index vol selling. And so, that trade has very much moved away from being like an all-weather risk premium kind of thing to more like a tactical thing, depending on opportunities. And sometimes you might want to actually totally be the other way. You might want to be short the single names and long the index. And so what we've seen is a huge amount of crowding from time to time in that trade. If you looked in February of this year, the pricing was reaching just incredible historical levels where single name vol was really expensive relative to index vol. There's tons of tourists involved in dispersion trades. People able to actually use like QIS at bank desks to do dispersion without even knowing how to trade options themselves, like all this kind of stuff. Then Liberation Day and DeepSeek really blew that out. Came back to, much more, normal kind of levels where then actually we got involved very heavily. So no, it's a really interesting trade and dynamic to watch, but it's very different now that you have this heavy index vol compression, coming out into the market.
Yeah, in 2017, I believe the stat is we had 30% lower realized vol than any other time in history.
Yep.
And we had also simultaneously 25% lower correlation between the constituents than any other time in history.
Yeah. Yeah.
That is not a coincidence. People first order effects are like, oh, the index is just a measure of what's happening to the single names. But the reality is often the opposite, right? The index itself is forcing this compression. And if certain names idiosyncratically need to go one way, by definition, by arbitrage, stuff has to go the other way. And I think that's really driving, like, again, if you look at history, implied correlation and correlation in general is just off the charts, right? Like, it's completely different than it was prior to this period. And it really is because this world is becoming central to the whole conversation.
Yeah, very much so. And I mean, this last couple of years, you've seen, especially with the rise of very aggressive retail option trading and that trading shifting from sector to sector and moving around, you've had a lot of like sector and factor rotation within the equity market universe that's really driven a lot of realized dispersion. You'll have, it's interesting. Like, so people talk about, there's a common meme, like, well, in a crisis, all correlations go to 1. That's not actually totally true. There are crises that are very high correlation and crises that are very low correlation. Depends on what's driving it, right? So when you have like a macro crisis that's like sovereign risk related, you tend to get very high correlations between different equity markets because it's not a fundamental thing. It's not an issue in certain sectors. But like if you go back to 2008, like we had days in 2008 crash where banks were limit down and energy was limit up on the same day, right? And actually that was a very relatively low correlation environment given how high volatility was. And so like there, and that's been much more similar lately. Like even with COVID, there was some very high correlation bits of it, but then you had, tech reacting very differently than to, consumer products and stuff on the back of the pandemic and all the fundamental moves you were seeing there.
Yeah, I think it's an interesting, like, crumb, like an important little detail that maybe people aren't thinking about because we had 2020, right? I think everybody saw correlation go to 1 or even above 1. If you have, it's kind of a weird concept, but it did. That dynamic was very much focused on the fact that vol was at the center of that issue on a macro level, that the S&P vol, that the macro vol was kind of driving everything. I wonder in this environment, to your point, not just because of the macro, but also because of the order of like maybe vol, people are more prepared for this one, et cetera. Even though it might be a big decline, maybe correlation doesn't work the way it's been working. And I think that's we'll talk about that if and when that happens. I think that's an interesting point.
Totally.
That leads us into big picture a little bit. Let's talk a little bit more kind of macro 10-year kind of picture. Obviously we've been talking about this for a while. I know you have too, but I think we're getting to a point where something different seems like it's happening. It's not exactly the same as the last 30, 40 years, especially as it relates to populism and protectionism and long-term interest rates. If interest rates continue to go higher here, right, and we continue to deploy these policies, these protectionist kind of unconventional, let's say, policies of the last 40 years, what does that do to vol? What does that do to vol in different parts of the market? Vol is not one thing, by the way, right? Vol is, we have FX vol, we have a commodity vol, we have, equity vol, we have bond vol, we have all kinds of things macro-wise. We also have, even within an equity vol, right? We talked about dispersion, but you have the long end of the curve, you have the short end of the curve. Give me your thoughts on what you think vol will do more structurally and how that might be different than we've seen for the last 10, 15 years. I'd love to hear your thoughts. Yeah,
totally. So I think a few different things. So first of all, in a rising and high interest rates and inflation environment, that drives a lot more kind of cross asset class vol than we've seen for, the last 20, 25 years. So like when we've had pretty low and pretty stable interest rates, for the most part, that's kept currency vol pretty subdued. That's kept certain parts of commodities vol pretty subdued. That's kept rates vol pretty subdued, depending on where in the curve. And we're very much shifting out of that kind of environment, right? I mean, we're seeing 10, 20 basis points moves in rates at different points in the curve on a daily basis. Right. We're seeing obviously big moves in gold. We're seeing, big moves in oil. And I think that's, one thing is just kind of structurally higher cross asset vol. Then next up, I think, inflation higher interest rates, and also policies, protectionist policies like tariffs create, winners and losers at different parts of the equity market, right? So I think that is like a pro-dispersion dynamic where you could see, significant pressures upward on vol in some sectors, certain pressures downward on vol in some sectors. Again, companies that are responding very well, companies that are responding very poorly. And so I think, there is kind of a structural bid to like single name vol and to, sector vol relative to index from that kind of dynamic for sure. And then I think, longer term, one of the things we think about is just, we've had really this notion of U.S. exceptionalism, the exceptionalism of American markets, driven by the fact that all the smartest people in the world come to the U.S. to study, to work, to create companies. And, you have every sort of big, meaningful tech company in the world is started in the U.S. as it ends up in the S&P 500. And, a lot of the current policy mix is potentially, challenging that thesis on a go-forward basis, right? And, what that does to long-term sort of equity returns and sector mix in the U.S. Do you start to see tech and some of the innovative sectors move elsewhere? It's a really interesting set of questions. I don't know the answer to it.
What does it do to the U.S. dollar?
What does it do to the U.S. dollar?
And maybe the most important thing, what does it do to the Federal Reserve and the exorbitant privilege of the U.S. dollar, right?
Yeah.
And I think those are big questions. It doesn't happen overnight, but it kind of happens very slowly and then all at once. So I think that's something that obviously we need to think about. I think one of the things I really think about as it relates, I completely agree with you, to this kind of structural change is the Federal Reserve itself, right? We had this Fed put that was unbreakable forever, for 40 years, since 1982, really. And the reality is that was because we had structurally low inflation. We had a deflationary environment, which allowed the Fed to come in and rescue, if they have dual mandates, price stability, and let's say GDP, I know it's maximum employment, but GDP growth, pretty easy to just keep on coming in and saving the market with infinite supply of money, when necessary. There's a big question. If this inflation is structural and we are truly in a stagflationary environment, which protectionism and populism, a lot of the policies you're talking about drive, then the Fed gets put in a box. And so if the Fed's in a box, I'm guessing that the bottoms aren't V-bottoms as much, right? I'm guessing there's a different kind of equity vol price action that tends to come from that in a bigger crisis when it happens. So I think it's a really important point. I think this moving away from supply side economics and the Federal Reserve running everything to a more demand side policy really drives a different vol outcome, particularly for equities. I did some historical research on this a year or so ago, and I think it's very interesting. The highest vol of the 60s and 70s, particularly like 68 to 82, that rising interest rate environment, was gold. Not too surprisingly there in some level, but also, and this is kind of counterintuitive, bond and FX vol, right? If you look at equity vol, and if you look at other commodity vols like industrial commodities, vol is actually structurally way lower. Short-term vol is about the same, meaning like 1 month, 3 month vol is about the same, maybe even at points higher at the very short end of the curve. But if you think about it, that makes sense. Equities did not move structurally for 14 years, 68 to 82, because it's a nominal asset.
That's exactly right.
The market didn't go anywhere. So you had this push-pull of two factors, which I want you to dive into, but which is one, as inflation happens, the market gets cheaper. By definition, the market's at the same, it gets cheaper, right? At the same time, you get multiple contraction because the discount rate or the divisor to equities in terms of a price earnings multiple is driven by that 10-year bond. And so this push-pull really just kind of almost like a vice that drives implied vol long-term lower and lower. With the structured product issuance increasing, the move into these things, I can see a really counterintuitive long-dated vol compression into a decline. Not yet. And again, it doesn't mean there are great short-term opportunities. And by the way, it doesn't mean the market's not going to have, there are actually more recessions, more vol events in that period. But I think that's really interesting and kind of
I think that's right. And even if you look at previous environments where we didn't have major inflation, but we had sort of a longer term bear market. You look at the tech bubble unwind and the bust 2001, 2, 3. Long-term vol really underperformed in that kind of environment, right? Because you just didn't, you had structured products. You didn't really have a bid for vol on the way down because you had this sort of choppy, rangy downside. And I think, exactly. With inflation surging, you think about, inflation has these mixed effects on equities, right? Because exactly to your point, the divisors getting cut. But equities, there's real asset ownership involved in equities. And so that gets repriced higher with inflation. And so, overall, like equities are probably a better place to hide than bonds through inflation in some sense. Obviously depends on all the kind of spillover effects,
yeah.
but it's very push and pull, right? There's very mixed effects going on.
Yeah. Yeah. I completely agree. Things like oil, by the way, and just talk about something other than equity vol here, actually had incredibly low vol in that period. You would think, OPEC crisis, it must have been crazy. The reality is it was like a steady grind higher. And the trade was actually to sell puts in oil and to buy calls in gold. Because the vol in gold was crazy, but it was also the best performing asset during that 60s and 70s period. So kind of an interesting kind of mental model to put around.
Yeah, very much so.
Put around things as you think about these things. From a macro perspective, right? It's hard to put these two things in your mind. That vol on a longer term basis may not perform, but you might get much more pinball, or that it might be a much weaker environment for equities, and you might get bigger declines along the way. So how do you, as a vol manager, how do you deal with these two kind of conflicting notions? Like what are some things that you do in order to take advantage of a need for much more non-correlated, much more need for hedging, not relying on 60-40 stocks and bonds, right? We need a much bigger toolkit, right? How do you do that in the same time?
No, I think that's exactly the right question. I mean, you think about traditional asset allocation, right, of like 60-40 stocks and bonds. That works in a traditional macro environment where equity market downside is cushioned by falling rates. Like we may well not get that. If you think about potential equity market downside scenarios from here being caused by some combination of policy uncertainty, of kind of concerns about the U.S. government or about inflation, those are things that make bonds and equities sell off together, right? And so, that traditional portfolio really doesn't work. And then you think about the institutional variation of that, where big endowments and foundations and pensions have adopted huge exposures to privates. That also, we've reached huge valuations, and a lot of that stuff, it's kind of not being marked. The liquidity profile is really dangerous. Like, how are those portfolios going to work out over the next 5-10 years?
I love that these are called alternatives, right? It's
exactly.
Like you're like, what alternatives are you in? Like, they're like, private equity and private credit.
That's right.
You're like, you mean 2x levered equities or credit, right? With 10-year duration, with no liquidity, right? And 2 and 20 fees.
Exactly.
I mean, it's not an alternative.
It's not an alternative. And a lot of those institutions are like 70% in those assets and have contingent private capital calls. They really don't have the liquidity. They're going to be, in a bad market, they're going to be selling that stuff at a discount in the secondary market. It's going to be a very bad scene.
And they've gotten away with it for 40 years, right? And that's why, recency bias, that's why it's grown to the size it has, because any decline we've had has been that kind of Federal Reserve put-driven quick recovery.
Don't have to market.
Less than 3 years. Don't have to market because it's a 10-year window. What happens? Big question. What happens if we get a 68 to 82 environment where over 10 years you have a decline in markets? Then you have to see the mark to market there. And that's when,
exactly right.
On a levered product with 2 and 20, the pain could be really bad. No liquidity getting out of a lot of these names.
I think that's totally right. And if you get a proper recession and a credit cycle at some point in there, you wind up with, private credit's gotten so overextended in terms of, every small business has 10 private credit guys knocking on the door trying to lend the money for absolutely anything. Yeah. And a lot of that stuff comes home to roost. So exactly to your point, I think like the need for alternative assets and alternative exposures and ways to make money over the next 10 years that aren't just driven by that.
True alternatives, right? True alternatives. I want to be clear, because everybody, if you go to your wealth advisor, you say, I need alternatives. 80% of that is private credit, private equity, real estate, and all of those have the same problems, right?
No, I think that's exactly right.
Yeah.
So to your point about, how do you manage this kind of environment? What are some of the things that vol managers think about? So again, we talked about not necessarily really expecting or seeing like a big sudden market crash with a big vol event, because you don't have the catalyst in place for that. You don't have the market structure in place for that. You don't have the positioning in place for that. Things that we think about, in 2022, actually being short delta versus short vol worked out really well, right? So on a market neutral basis, you get that kind of grind down, vol's underperforming, the short delta works really, really well. That's one trade that's performed really well. You can think about different kinds of option structures, like longer term downside put flies, right? Things where you're not betting on that big crash. The big crash isn't going to work out. You're spending a little bit of premium, but doing really well if you get that 10% grind down or that 15% grind down. A lot of those kind of trades can work out really well in that path. Yeah, just getting out there and, buying a whole bunch of Vega, may really not.
Yeah.
The other thing that, and you alluded to this, but, there's so much supply of short dated options in the world, all the call overwriting, all the cash secured put selling out of big institutions and everything. that inevitably that gamma in the front of the curve stays kind of cheap. And, folks like us usually end up staying long that. And then you think about this environment with, tweet driven policy or, reversing with the market down, market up, like, new tweet market gaps up 2% in the futures and then sells off the next day. Owning that gamma is really nice because you can just scalp that sort of P&L from market movement.
Right. Because at the end of the day, if you are more likely to get those declines, and they are actually more likely to even be bigger because the hedges aren't working, right? You're going to get the realized move. And again, it may not be as fast, but you're going to get some type of meaningful decline likely in those scenarios. The key is, managing the implied vol part, which can be a little hard. And when interest rates go higher, I can't emphasize this enough. As interest rates go higher, you get to now stack a return on top of a T-bill yield, which is going higher. That dynamic, which isn't very well understood, is what's driving the structural product boom, by the way. People don't really understand this. Because if you could get, let's say, a 3% yield on or 4% yield on something, but you were getting 0% underneath the hood on the risk-free rate, it wasn't competitive.
Mm-hmm.
But guess what? When you get to a 4.5%, risk-free yield and you stack, let's say 4.5, all of a sudden it's very compelling in a non-correlated way with way less risk. Why would you be in equities, given the risk when you could do that? And so I think that story is very compelling. And I think a reason why I think everybody needs to be looking more non-correlated.
Yeah, no, very much so. One thing that we do, obviously we run the absolute return, hedge fund stuff, but we also work with big institutions that need to think about this kind of hedging question of how do we manage a big decline in equity markets? And, think about all these questions about the path and, but the amount of capital involved can be very small, right? Because you're running derivative overlays for someone with a ton of cash efficiency and can generate, a ton of P&L in the scenarios they're worried about with very, very, very little capital.
Right. I think the challenge obviously is, 60-40 scalable. It's easy, right? And so when you look at non-correlated assets, it's hard, like we were saying. And so I think we're seeing a ton of innovation and a ton of growth in the space. But this is still 1% of the space, right?
Yeah.
And what we've seen is, we were just at an equity derivatives conference, right? It's like almost a doubling of the people there every year, much like the structured products doubling. I'm here to tell you, we went from 0.5% to 1%, right, in the last several years. And this should be 10, 15, 20% in terms of non-correlated products. If you look at a 60-40 portfolio, people don't talk about this, but a 60-40 portfolio over 125 years, we take this last 40 years in that data, and you really need to look at a broader data set. And people look at me like I'm crazy because the last 40 years have been top left to bottom right interest rates, which is the most important thing. So if you look at a broader picture, the 60-40 portfolio has a 0.45 Sharpe.
That's right.
Stocks have a 0.32 Sharpe. You and I know in our world, right? Like risk-adjusted returns, that's awful.
Totally.
Like if you can only manage that in your portfolio,
and people
you're
look back
it
at equities the last 15 years and they think it's like 1.5 Sharpe game.
Right?
It's not.
Right.
Not through the cycle.
And actually, the other part is that's over 125 years. So we're talking 60-40 in general. If you don't know where things are going, but after periods of increasing interest rates, you're more likely, obviously, to get, declining interest rates, you're more likely to get increasing interest rates, right? And if you get increasing interest rates, those periods are the times when the 60-40 portfolio gets hurt the most, right? Because the divisor, as we were talking about, the discount rate affects bonds and stocks and pretty much every other asset, right?
Completely. Yeah. No, and you look around the world, obviously U.S. equities have been incredible. And again, this American exceptionalism dynamic, but you can look at markets like Japan where you had, 10, 15, 20 years of, flat to down equity markets. That's a realistic scenario in some cases where you start at really high valuations. You have kind of a big shock to the nature of things. A lot of that comes out of the market. And I think American investors just are not at all psychologically prepared for the idea that can happen. Right?
Yeah. I'll tell you what, this floor will be a lot more full and there'll be a lot more of us, in these conversations. But I think it's important, right, that to do it now, right? I'm fearful that people will start doing this more in 5, 10, 15 years after it's too late. And by then 60-40 might work a lot better.
No,
right?
it's totally true. And it's always a dynamic. Even again, I mentioned we help folks with tail hedging. You always have the most interest in tail hedging right after a market crash.
Right.
Come on, guys.
Right. Well, this is like playing fighting the last war.
Fighting the last war. Exactly what you said.
Yeah, completely. Couldn't agree more. So what about zero DTE, right? Where, obviously we're talking about front end of the curve, back end of the curve. Do you use zero DTE options at all? How do you use them? Obviously the most kind of, the moment on the distribution that is the most impactful. Give me a sense of your thoughts of zero DTE. Obviously, I think it's like almost 60%.
Yeah, they're up to about 60% of volume. I think there's a few different big flows there as far as I see. One, there's a lot of people using them for intraday levered directional exposure. And that's both retail and hedge funds. So there's big macro hedge funds that they want to get long today. They get in there and they buy, upside 20 delta calls and their call spreads in big size, right? So that's one big flow. Another big flow on the other side of that is there's a lot of income type sellers. So there's, people that just sell them outright, the downside, the near the money. There's people who do call overwriting, like daily call overwriting. They own some equities and just every day they come in and sell zero DTs. And you've got, some pairing off between those two flows. It's not one way. There's buyers, there's sellers.
Right.
And then I think the third big category, and that's a decent part of the volume, is just a lot of like big complex option portfolios, market makers, prop firms, us. We just use it to constantly clean up the book. Like every day, it's like, oh, I've got this expiring. In the old days, you just had to hold whatever weird gamma positions that you had at different strikes, and now you can just come in and kind of clean up your book on a day-to-day basis. So there's a lot of volume in that. So I think it's actually a really useful, tool. We do some of that from a portfolio management perspective. We do have strategies where, we're getting in and trading the zero DTs, usually looking for days where we think that, it's just gamma's too cheap, like the straddle's too low, and, we'll come in and buy some zero DTs and maybe near the money, maybe a little further out of the money and kind of let it run. But yeah, it's a really interesting space.
What are the most structural? Are there any structural things on the zero DT side that you think are like edges because of supply and demand? I don't want you to give up your secret sauce or anything, but if you think there's any parts of I'd be curious to hear your thoughts on.
Yeah, really, I think the only part of the distribution where there's I think a pretty net supply demand imbalance is there's some pretty big selling of crash in zero DT of crash puts.
Yeah.
There's like an account out there, for example, that trades actually OTC with a bunch of banks, like to get more leverage, and it is sized such that probably if there's a big 1 day down move, it's going to be a major issue for a lot of the banks.
Right.
On their side of that, there's not too many buyers of that stuff. You can see it in the skew curve. If you look at the term structure of skew, it's a fascinating thing for people who believe in emerging markets, because the term structure of skew is like this super inverted U-shaped thing where skew at the front end is really low, in the middle of the curve is really high, and at the back end is really low. Structured products are selling the back, hedges are buying the middle, and then crash put sellers are selling the front, and you just see it right there in the price.
Totally. No, that is actually, we see the same thing. Obviously, an incredible opportunity. Skew itself, right, is like probably the biggest structural opportunity, right? The question is, how do you manage that tail risk, right? What are your kind of most favored, and you can list several ways to kind of think about getting convexity in general, managing what's already a steep skew out there and trying to get that convexity, not just in equities, maybe other parts of the market, different parts of equities. I'd love to hear your thoughts.
Yeah, totally. So a couple different things. Like whenever we're thinking about how we want to structure the portfolio, both for absolute return and tail hedging stuff, we're always thinking about, okay, what's oversold? Where are there structural flows in the market that you want to be on the other side of? And then what can you sell against it? And so in that example, we talked about structured products, right? So there's a ton of selling of long dated downside, both in index and in the momentum single names that are investors' favorites. So what that lets guys like us do is we'll be buyers of that long dated downside. Call it 2 year 10 delta, 20 delta puts, for example. And in the absolute return business, we will sell something else against that, maybe 6 month, maybe 9 month 10, 20 delta puts, and then buy a little bit of gamma at the front end to neutralize the thing. And what you end up with is a curve trade where you're buying vol, 10 or 15 points below where you're selling it. And then the dynamic there is, because structured products typically are effectively what investors are doing, they're selling knock-in puts, right? They're not just regular puts. They have a barrier where if the underlying hits that barrier, the note goes away, the investor just loses a bunch of money, and then the bank loses its long vol position, right? So when the bank issues these, they immediately are going out in the market and selling vanillas against it. They're selling those crash puts. Right. And so when the market goes down enough, when those names go down enough, they start hitting those barriers. All of a sudden, the banks lose all their long vol positions. They have to scoop up all the shorts. They have to buy it all back. And there's like this big short squeeze in long dated vol, right? So you have a mechanical long convexity to that position that comes from knowing that you own the stuff that there's going to be a short squeeze in if the market sells off.
Supply and demand.
Supply and demand.
Yeah, I agree. I couldn't agree more. And importantly, and I think you alluded to this, even when that doesn't happen, at least you're getting the benefit of that long dated compressed vol eventually sliding up the curve, and other natural buyers coming in and kind of supporting it.
Exactly. So you have a nice positive carry to that long convexity position.
I couldn't agree more. That's a great point. Anything else that's on your mind these days? Things that you're kind of thinking about here as we move forward in the next to the summer and into the fall?
Yeah, I mean, I think the interesting thing, with the summer here is really going to be to see, I think, what sticks in kind of tariff policy, what doesn't. We've had a lot of back and forth, right? Obviously, we had Liberation Day, looking really, coming in really high with those numbers. Then we had a lot of it walking back, and now we're actually getting some pushback the other way, where Trump is kind of coming back out and going after China again and saying, "Oh, you're not negotiating in good faith," coming back after Europe. And so, I think it'll be interesting to see whether this just kind of keeps on going and we keep rolling the timelines out, or whether we actually start to get, some of these levels put in place and some really big changes. I think that's going to be a big driver of what we see in, near-term economic performance and earnings for a lot of corporates.
Yeah, I couldn't agree more. The long end of the curve, we've kind of alluded to inflation and long-term. Yep. We've yet to see the effects of the increase in tariffs and not just what's going to happen, but what are the net effects of what's already been instituted going to happen? Part of that's been particularly muddy because obviously if you say, we're going to do tariffs in 90 days, everybody's going to pull forward demand. And so that pull forward of demand is actually really muddying even more. We don't know what lies on the other side of this, not only in terms of policy, but even in the current policy structure. This is a much less linear kind of outcome. Actually, it could be very kind of, again, front-loaded and empty on the back end.
100%.
So I think there's a lot going on there. And as we've alluded to a couple times, the long end of the curve in terms of interest rates, look, if this keeps going higher, I mean, we have a ton of refinancing that needs to happen, not just in commercial real estate, not just in, private credit, non-investment grade equities. I mean, we could go on and on about it. The majority of the refinancing happened in 2020 and 2021. And the average duration was 5 to 7 years. So you do the math, right? If you look at Shiller's like CAPE index, right? Obviously we're at record kind of levels. But the reason that doesn't work so well as a timing indicator is because there are long and variable lags to interest rates. And the reason there are variable lags is because it's very different if interest rates are steady at 4, the amount of refinancing that's happened, relative to, let's say, they go to 1%. Guess what? Everybody coming in, and the lag is going to be a little bit longer, right? So I think we've had this real lag on the exposure to interest rates, and it really is that check's coming due. That's my opinion. I think we have people like, interest rates went for 50 basis points to 4.5. Everybody said interest rates are going to be a problem. See, they're not a problem. Well, it doesn't matter till supply and demand, right? And so I think that's a really important point. I think people are kind of whistling by the graveyard. And I think that's why the long end of the curve, by the way, is just like tick, 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 like slow motion, train wreck happening there. And the administration knows it's a problem, but they haven't been able to do anything about it.
Yeah, just think about the housing market. I mean, the valuations, the price to buy a house relative to people's income in the U.S. has gotten so out of control. Especially in San Francisco and major metropolitan areas. And it was one thing when, rates were 0 and you could get that 30-year jumbo at 2.8, percent or whatever. But now you're at 7, 7.5, 8. And like housing prices haven't really adjusted yet. But, as more and more people need to come into the market and need to buy a house, like how are they possibly going to be able to come up with that kind of cash, right?
Yeah, they still have to buy, right? And that's the thing. We are sending money from the top more to the bottom. It doesn't feel like it, but it is, at least in the last 8 years, right? And protectionism does that to some extent, right? So that policy is ultimately driving more demand. We're creating more households. We're sending more money to millennials who are chasing these crazy market prices, but have to. If you want to start a family, you need a place to live. And it's a crazy dynamic and very different, as we've said, than the last 40 years.
Very different.
Very macro-driven world. Definitely a time for need for non-correlation.
100%.
Thanks for joining us today, Ben. Appreciate the conversation and look forward to having one again sometime in the future.
This was so much fun, man. Thanks for bringing me down.
Good to see you, buddy.
Awesome.
You bet your money just got made. Convex.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to your favorite podcast platform and follow the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged. But before we go, we just need to remind you that this podcast expresses the view of KaiNexus LLC and the guests appearing on the podcast as of the date of its recording, and such views are subject to change without notice. KaiNexus LLC and Top Traders Unplugged do not have any duty or obligation to update the information contained herein. Furthermore, KaiNexus LLC and Top Traders Unplugged make no representation to its accuracy, and it shall not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This content is made available for educational purposes only and should not be used for any other purpose. The information contained in this podcast does not constitute and should not be construed as investment advice or an offering of advisory services or an offer to sell or a solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends, performance, and other data is based on or derived from information provided by independent third-party sources. KaiNexus LLC and Top Traders Unplugged may believe that the sources from which such information are obtained are reliable. However, each of KaiNexus LLC and Top Traders Unplugged cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be reproduced, copied, republished, or posted in whole or in part in any form without the prior written consent of KaiNexus LLC and Top Traders Unplugged.